السلام عليكم ورحمة الله وبركاته. Managerial accounting, budgetary control and responsibility accounting. And this recording we will complete apply responsibility accounting to cost and profit centers and learning objective number 4, evaluate performance investments centers. Types of responsibility centers. 3 basic types: cost center, profit center, the third investment center. In this slide we will determine cost center. Cost center incurs cost doesn't generate revenue. In cost center only cost incurs cost doesn't generate revenues. Managers have authority to incur cost. Managers evaluated on ability to control cost. Usually a production or service departments considered as cost center. The following slide we will discuss profit center. The profit center incurs costs and generates revenue. Two things. In the profit centers there are costs also there and generate revenues. In the profit center incurs costs and generates revenues. Managers judge on profitability of center. The evaluation for managers on profitability. Examples include individual departments of a retail store or branch bank office. The following slide for investment center. The third basic types investment center. Investment center an investment center incurs three things: cost, also generate revenues, and has investments funds for use. An investment center incurs cost, generate revenues, and has investment funds available for use. A manager evaluated on profitability and rate of return and on funds. Rate of return. Here the manager evaluating on profitability, also on rate of return on investments of a subsidiary company or a product line. Investment center may be as a subsidiary company or product line. Manager able to control or significantly influence investment decision. Summary of the types of responsibility centers. The first, cost center, incurs expense only. The first type, cost center. In cost centers, the manager responsible for incurring expenses, costs only. The second type, profit center. The manager is responsible for two things: expenses and revenues, and evaluated considering expenses and revenues. The third type, investment center, is consider expenses and revenues and return on investments. In investment center, the manager is responsible for expenses to reduce expenses and to increase revenue and for return on investments for fixed assets, property. As you see, investment center, the manager responsible for cost reduction, increase revenue, and return on investments. Under responsibility accounting, the evaluation of the manager performance is based on matters that are that the manager directly control, directly and indirectly control. Indirectly control has shared responsibility for with another manager. Has shared responsibility for with another managers. As you see in under responsibility accounting, the evaluation of managers' performance based on directly control on matters that are directly controlled. Responsibility accounting for cost centers. Responsibility accounting for the first type, cost center, based on managers' ability to meet budgeted goals for controllable costs, results in responsibility reports which compare actual controllable cost with flexible budget, include only controllable costs in report, no distinction between variable and fixed cost. In cost centers, result in responsibility reports which compare actual controllable cost with flexible budget. To the report shown in is adopted from the flexible budget report for Fox Company in illustration 1016. Finishing department responsibility report for the month ended January 31, 2020. Has the budget, has the actual results, here the difference, favorable or unfavorable. In a responsibility report, only controllable cost controllable cost will appear in responsibility report. Indirect materials actual higher than the budget, so the difference 500 and favorable. But indirect labor, the actual is less than budget, so the difference 1000 is favorable, and so on. The total, we have 400 favorable difference. Again, in a responsibility report, only controllable cost will appear in the report. This report assumes finishing department manager is able to control all manufacturing overhead costs except depreciation, property tax, and his own monthly salary of 6,000. So these things not appear in a responsibility report. Remaining 4,000, 10,000 less 6,000 of supervision costs are assumed to apply to other supervisory personnel within the finishing department whose salaries are controlled by the manager. For the second type, responsibility accounting for a profit center. For a profit center, based on detailed information about both controllable revenues and controllable costs. Evaluation for a profit center for controllable revenue and controllable costs. Manager controls operating revenues earned such as sales. Managers controls all variable costs incurred by center because they vary with sales. So in the profit centers, we evaluate with considering controllable revenues and controllable costs. Direct and indirect fixed costs. Direct fixed costs relate especially to one responsibility center incurred for sole benefit of the center, called traceable costs, since they can be traced directly to one center. Most direct fixed costs are controllable by profit center manager. So the fixed costs, direct fixed costs, considered controllable by profit center manager. But indirect fixed costs pertain to companies' overall operating activities incurred for benefit of more than one profit center, called common cost. Since they apply to more than one center, most are not controllable by profit center manager. Because indirect fixed costs not controllable, it's not appear in a responsibility report. As you see, a responsibility report budgeted and actual controllable revenues and costs. Only budgeted and actual controllable revenue and cost will appear. Uses cost volume profit income statement format. Deduct controllable fixed cost. Deduct controllable fixed cost from contribution margin. Controllable margin excess of contribution margin over controllable fixed cost. Non-controllable fixed costs are not reported. Non-controllable fixed costs are not reported. Here's responsibility report for marine division. Consider a profit center. Profit center will evaluate in controllable revenue and controllable costs. Here's the budget figures. Here's the actual results. Here's the differences. Sales, less variable cost of goods sold, selling and administrative total equal contribution margin. Contribution margin is 36,000 favorite. Controllable fixed cost, less cost of goods sold, selling and administrative total contribution controllable margin. A report doesn't show non report doesn't show non-controllable fixed cost of 6,000. This cost would be included in a report on the profitability of the profit center. Here's profit center. Only the controllable sales revenue and controllable expenses will appear in the report. In a responsibility report for a profit center, controllable fixed costs are deducted from contribution margin to show controllable margin. Deducted from contribution margin to show controllable margin. As you see in the previous slide. Do it profit center responsibility report. Midwest division operates as a profit center. As a profit center is responsible for revenue and cost. It reports the following for the year: budget data, actual data. Prepare a responsibility report for Midwest Division for December 31, 2020. Here sales, variable cost, controllable fixed cost, non-controllable fixed cost. As you know, non-controllable fixed cost will not appear in a responsibility report. Here's the differences. Sales budget 1,500,000, actual 1,700,000. The actual higher than the budget, or this is revenue. The difference 200 favorite. A variable cost, the actual higher, so the difference 100,000 and favorite. The difference when we evaluate revenue, the higher is the best. In expenses, the lower is the best, and so on. Contribution margin 100,000 favorite. Controllable fixed cost 0 difference. Controllable margin 100,000 favorable. The third type of responsibility centers, investment centers. Return on investments is the primary basis for evaluating the performance of manager of an investment center. Return on investments is the primary basis for evaluating the performance of a manager of an investment center. Shows effectiveness of manager using assets at her disposal. Factors in return on investments formula are controllable by manager. Return on investment equal controllable margin divided by average operating controllable margin divided by average operating assets equal return on investments. 1 million divided by 5 million, 20%. Operating assets include current assets and planned assets used in operation by center and controlled by manager. Return on investments. Operating assets include current assets plus planned assets used in operation by center and controlled by manager. This operating assets, current assets plus planned assets. البيس for average operating assets on beginning and ending cost or book value of assets. We use here average beginning operating assets زائد plus ending operating assets divided by 2. Responsibility report. Scope of managers responsibility affects content. Investment center is an independent entity for operating purposes. All fixed costs are controllable by center manager. Shows budgeted and actual return on investment below controllable margin. Here's the responsibility report for Marina Division, which considered investments center. Budget data, actual data, differences. Here's the controllable margin. Contribution margin. Contribution margin divided by average operating assets equal return on investments. On budget 15%, but in actual the return on investments only 13.2%. Difference is decrease 1.8%. It's unfavorable. Return on investments on budget 15%, actual only 13%. The difference is unfavorable. Judgment factors on return on investment. Valuation of operating assets. Operating assets, we can use acquisition cost, or we can use book value or appraised value or fair value. So when we calculate average operating assets, we can use any from these items: acquisition cost, book value, appraised value, or fair value. Each of them provides a reliable basis for evaluating performance. Margin income measures: controllable margin or income from operation or net income. Only controllable margin is a valid basis for evaluating performance of manager. Margin income, may we use controllable margin or income from operation or net income. Here's in responsibility accounting the best to evaluate controllable margin. improve return on investments by increasing controllable margin and or reducing average operating assets. How to improve return on investments? We have two ways. First, increasing controllable margin. If controllable margin increased, return on investments increased. On the other way, we can improve return on investments if we reduce average operating assets. Here's the current situation. Sales 2 million, variable cost, contribution margin, controllable fixed assets, controllable margin 600,000, average operating assets 5 million. Given return on investments A over B 12%. This data is assumed data. Here's the current situation. In the current situation, return on investments 12%. In the following slide, we will try to show the effect in increasing controllable margin. If the controllable margin increased on return on investments. If we increase controllable margin, return on investments increase. Also, when we reduce average operating assets, if we reduce average operating assets, the return on investments increase. Again, this is the current situation. Improve return on investments by increasing sales or by reducing variable and controllable fixed assets. Increase sales by 10%. If we increase the sales by 10%, sales increase 200,000 and contribution margin increase 90,000. 200,000 times 45%. Controllable margin increased to 690,000. So return on investments will increase to 14.8%. Here's the current situation. If we increase sales 10%, variable cost will increase 10%, and we calculate a new controllable margin. When we divided on average operating assets, the return on investments increase. So, by increasing sales, we can increase or improve return on investments. Increase 10% in sales result in increased return on investments, higher percentage for almost 14%. On the other way, we can improve return on investments by reducing or decrease variable and fixed cost. Decrease variable and fixed cost 10% will result in increased return on investments. Also, if we reduce average operating assets, return on investments increase. Assume that average operating assets are reduced 10%. Average operating assets become 4 million and a half. Controllable margin remains unchanged return on investments will improve to 13.3%. In the formula for return on investment, the factors for controllable margin and operating assets are respectively هنا controllable margin dollars and average operating assets. As the Surface Division Omithro Industries reported the following results for 2020: sales, variable cost, controllable fixed cost, average operating assets. Management is considering the following independent courses of action in 2021 in order to maximize the return on investments. Reduce average operating assets by 80,000 with no change in controllable margin. Alternative 1. Alternative 2. Increase sales 80,000 with no change in contribution margin percentage. Now, in this situation, compute controllable margin and return on investments for 2020. Here's return on investments. Compute control margin and return on investments for 2020. This is the current situation. The current situation, return on investments 14%. Now we will see alternative 1. Alternative 1, compute controllable margin and expected return on investments. For alternative 2, it's 19.7%. Here's the current situation, 14% return on investments. In alternative 1, the return on investments will be 19%. In alternative 2, 19.7%. We end this chapter. See you in next recording. Assalamu alaikum wa rahmatullahi wa barakatuh.